To drill down further into these developments in the global oil market, we are joined from Florida now by Kent Moores, the executive chairman of the Energy Capital Research Group. Welcome to the broadcast. Thanks for joining us, Kent.
Well, thank you very much, Susan.
Oil hitting two-year highs. Is this a result of this Saudi corruption crackdown, or is it supply-demand related?
The answer is sort of yes and yes. We have been moving consistently toward an essential balance between supply and demand globally now for quite some time. What has occurred in Saudi Arabia has been a ripple that has been added to this, but we've also seen some other developments within OPEC itself. Now, both OPEC and Russia give every indication that the cuts will continue through 2018, and that, of course, is buttressing prices. But what we're witnessing here is Venezuela's production is collapsing. Libya and Nigeria cannot maintain the levels that they had expected at this point. There's a bit of flexibility now in OPEC that will allow other members of the cartel to overproduce and get away with it without costing on the price side. So there are a number of factors here that are sort of contributing to a rise in price.
Let's pick up on Venezuela there. The market's been crushed by the U.S. shale oil boom. A lot of oil service firms are now faced with writing down their debt, suppliers with overdue bills linked to these oil field service companies. What is the overnight fix to this situation?
Well, I think the market itself is now correcting, and it's correcting because of essential market dynamics. What actually occurred over the last 2 to 2.5 years is that the operating companies in the United States actually increased efficiency. And in most cases, that efficiency resulted in an improvement of 17 to 23% at the wellhead. They actually were producing for far less than what it cost them 2 or 2.5 years ago. The downside to that, of course, was that the cuts were being pushed upstream. So the Halliburtons and the Schlumbergers and the other oil field service companies were actually having to agree to essentially provide services at much lower rates to keep the contracts operating. That in itself is also beginning to rebalance. And so as a result, we're seeing the oil field service companies themselves having gone into a protracted merger and acquisition cycle over the last 3 years or so. We're beginning to see that readjust, and we're correspondingly beginning to see their bottom lines improving.
Let's circle back to OPEC. Saudi Arabia and Russia are leading this deal between OPEC and non-OPEC producers to cut the oil supply in hopes of draining global inventories and propping up the oil prices. Brazil has informally rejected the offer. Uzbekistan is in. There is that meeting in Vienna, as you know, at the end of the month. What do we expect to come out of this?
I think the next OPEC meeting will be an agreement in principle to continue the cuts and the caps through the end of 2018. I think there is consensus here that essentially they have worked and that most of the members of OPEC are on board. The non-OPEC producers are essentially led by Russia, and Russia at this point will agree to the cuts and the caps through the end of 2018. The other major non-OPEC producers aren't really in a seat where they can command as much as they used to. For example, Pemex in Mexico has a series of shortfalls in their main producing fields that is causing a constriction in their overall supply, their constriction in their overall extraction volumes. And that was something that's even beyond what it is that people in Pemex, the state oil company down there, themselves were arguing was likely to occur. Kazakhstan has a good deal of its oil actually determined by Russian export pricing dynamics, because the Kazakh oil, a good percentage of it, is actually running through export venues that are controlled by the Russians. So it is not as, with the non-OPEC producers, it's not as there is Russia and there are a number of other countries. There really aren't a number of other live options at the moment.
Quickly, Kent, do you think the American drillers are going to be able to deliver this shale crude oil that's in demand over the next few years?
Yes, and I think we're much better positioned to do this with a responsible market balance than we may have been a little while ago. We went through a very bad period in which the prices had collapsed And a number of producers in the United States were literally producing as quickly as possible to sell the oil for whatever they could get, because essentially they were one step ahead of the sheriff. The debt encumbrance was just enormous. Well, we've had mergers, we've had acquisitions, we've had straight-out bankruptcies. The companies that are now surviving in the shale space in the United States are much better equipped to bring volume to the surface at a price which allows for the higher rising of the oil pricing floor. And that's all you have to look at. Forget about the spikes, forget about the overall daily figures in terms of where WTI and Brent ended up in a given trading day. Take a look at the floor. If the bottom level of the pricing range is slowly rising, that balance is being set in, and that balance essentially is going to bring us slightly higher prices over time.
Well, Kent Moore is with Energy Capital Research Group. Thank you.